let's talk about the stock market. Most people buy shares, hope the price goes up, and sell for a profit. Simple, right? But what if you could make money when a company's stock crashes? That's called short selling. Short sellers are the market's professional pessimists. They bet against companies they think are overhyped or poorly run. Instead of cheering for success, they profit from failure. The idea: you bet a stock will drop in value. If you're right, you cash in on the company's downfall. It's a bold, sometimes controversial move, but it's a big part of how markets work. Why do it? Money, of course. But also, short sellers can expose fraud and hype, keeping the market honest. They're the ones pointing out cracks in the foundation when everyone else is celebrating. Sometimes they're heroes, sometimes villains, but they always walk a fine line. Short selling is risky, complicated, and fascinating. Let's see how it actually works. So, how does short selling work? It starts with selling something you don't own. First, you borrow shares from a broker for a fee. Then, you sell those borrowed shares at the current market price. Now you wait, hoping the stock price drops. If it does, you buy the same number of shares back at the lower price. You return the shares to your broker. The difference between your selling price and your buying price, minus fees, is your profit. For example, borrow 100 shares at $50, sell for $5,000. Stock drops to $10, buy back for $1,000. Return the shares, keep the $4,000 difference, minus fees. You made money because the stock went down. It's like borrowing a friend's car, selling it, buying it back cheap after a recall, and returning it. Complicated? Yes, but that's the basic playbook. Now let's make it even simpler. Imagine your neighbor Timmy sells lemonade for $10 a cup. You know it's just sad lemon water, and predict the price will crash. You borrow a cup from Susan, sell it for $10. News breaks: Timmy's lemonade is a scam. Price drops to $1. You buy a new cup for $1. Return it to Susan. You keep $9 profit. You made money because the lemonade lost value. That's short selling in a nutshell. It's betting on failure, and if you're right, you profit. Simple, but not always easy. Now, let's see how this plays out in the real world. Buckle up. Short selling isn't just for lemonade stands, it's moved billions in the real world. Michael Burry, made famous by The Big Short, bet against the housing market before the 2008 crash. He saw the flaws, shorted mortgage-backed securities, and made hundreds of millions when the market collapsed. He was right, but it triggered a global crisis, so not exactly a victory parade. More recently, GameStop in 2021. Hedge funds shorted the stock, betting it would fail. But Reddit investors bought up shares, driving the price sky high. This forced short sellers to buy back at huge losses. A short squeeze. Billions were lost, and chaos reigned. These stories show short selling can bring glory or disaster. It's high risk, high reward, and sometimes high drama. The lesson? Short selling is powerful, but dangerous. Let's talk about why it can go so wrong. Here's what you need to know. Tempted to short everything you dislike? Hold on. The risks are massive, potentially unlimited. If you buy a stock, the most you can lose is what you paid, but if you short a stock, your losses can be infinite if the price keeps rising. That's what happened with GameStop. Short sellers lost billions as the price soared. A short squeeze can force you to buy back at sky-high prices, compounding losses. Short selling isn't for beginners. It's complex, risky, and requires deep research. For most people, it's like defusing a bomb with kitchen tongs. You might get lucky, but you could lose big. So, be careful. Short selling can make you rich or ruin you. Know the risks before you bet against the crowd. Sometimes it's better to just watch from the sidelines.